Coming off the back of the longest weekly losing streak of the year so far, and we're looking for a bounce here. Live from New York City this morning. Good morning, good morning. Equities up by 0.9% and yields lower. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
Live from New York, coming up, equities bounce following the worst week of 2023. The White House thinks China is target south in knots, and Twitter delivers a fresh round of job cuts. We begin with the big issue, the longest losing streak of the year.
The equity market is coming to terms with the fact that the job is not done for the Fed.
The economy does look hot.
A bit too hot to ignore.
We still have a high inflation environment.
It is still elevated. It is still pretty sticky.
Inflation remaining stubbornly higher than what the Fed wants.
It's going to be harder for them to stop raising rates.
Got a lot of big hurdles to clear.
I wouldn't be participating in stocks right now.
We are underweight stocks.
I would not rule out a return back to the lows.
We are due for a recession.
I call it the bearish truck, and it's coming.
Rough roads are ahead.
We're landed. The question is, do we hit the wall at the end of this runway?
Joining us now to discuss is JP Morgan's Jack Caffrey, Seema Shah of Principal Asset Management. Seema, let's begin with you, and thank you both for being with us. Seema, I remember the start of the year, we were meant to shift our focus away from inflation, which was too high, to growth, which was going to be too weak. It's not. What happened?
Well, I think we all got a bit of a head fake in December, made everyone think that actually, we were kind of near the end. But actually, it looks like Fed is still the main conversation here. If anything, some of the data that we've been seeing, which has suggested that the US economy is actually a lot stronger than certainly many had expected, that's just telling us that there is more work for the Fed to do. So it's not just about the growth picture. It really always comes back to the Fed. So we are not past that just yet.
You're not alone. Jack, I wanted to share this quote with you. I think it will resonate with you. This is from Citi's Stuart Kaiser, who said this: "There is a tendency to read all moves in rates negatively. Higher rates mean growing inflation risk, while lower rates point to hard landing outcomes." Now, Jack, you've pointed it out yourself. Bad news was good news through much of the last decade or so, and now too much good news is bad news too. Can you make sense of that, Jack?
Of course. If we think back over the prior decade, bad news effectively kept the Fed sidelined and let us operate, particularly as equity investors, in an environment where the cost of capital is minimal, negative for so many companies. Now we get to a situation, thanks to the combination of COVID relief, the stimulus, the series of spending programs from fiscal authorities, plus a still accommodative monetary policy when you think about where real rates are, and you come back to the environment where inflation has been sticky, even if it's going in the right direction. The job market has continued to be really good news, and the consumer remains quite engaged, even if it's not necessarily as profitable as retailers would like. So I think the Fed remains reactive to the data rather than forward-looking, if you will, with respect to the data, and that leaves the equity market effectively getting whipped around by what happens at the long end of the yield curve.
Jack, are you saying they're still too accommodative at the Federal Reserve? Are they not sufficiently restrictive?
I think that they are struggling to come up with just how restrictive they need to be. And this comes back to the age-old question, which monetary policy works with lags. And the question is, how much of a lag do we have to look at? When we think back to the big shock, economic surprises have been nicely positive over the past, call it 3 months, which tends to suggest that the overall investing environment or the overall investment community has been well calibrated with the outlook. So where we have seen surprises, it's been things, particularly positive surprises, have been labor and jobs, and that's probably the hardest data to come back to understand. And so I think that comes back to the Fed is acting with a lag in terms of looking at the data and not really effectively still being a little easier than they would like to be, all considered.
And because of that, another thing that hasn't broken in 2023 is just this correlation between stocks and bonds. Seema, last year, stocks and bonds fell together. This year, they've risen and fallen together. Again, this morning, you can see this playing out. Equity futures are higher, yields are lower on the session. Seema, we were told repeatedly by many people on this program, other shows too, on this network, that correlation was going to break down. Why isn't it breaking down?
I was one of those people. I still believe that diversification is going to be back in 2023. But as you said, it's not quite showing through yet. And the relationship where you have strengthening growth and yet still tightening Fed, I think, is confusing things a little bit. Now, we do think that equities are going to find a tougher time as we get through 2023, and at the same time, bonds is going to be the place to hide out because typically as you get through to recession, you're going to have yields coming down. But I have to say, the first 2 months of the year have been very, very confusing. I think, as we've just heard, markets, we've all been whipped around pretty significantly. And it's important to take a slightly longer view because at the moment, following data by data, that's when you're going to get confused. You're going to take a slightly longer term view, take the fundamental perspective, and that's going to give you the way out through this.
Well, Seema, go back to the day before payrolls. Day before payrolls, equity market peaks on the S&P 500, up 9%, on the NASDAQ, up 17%. The day before payrolls, everything was looking good. It was the day after the Federal Reserve. It looked like that disinflationary process was just starting. The chairman's words, not mine. Then the payrolls report drops, and the whole narrative switches, it changes. And Seema, I keep going back to this. Is there any reason to believe that the February data, the March data, repeats the resilience, the buoyancy of what we saw in January?
Well, I think we do, right? So it makes sense. Look, consumer spending is still very strong. Why is it very strong? It's being held up by savings and people are dipping into credit card balances. The labour market, we know, is still very, very tight. And that's a continued kind of legacy from, I think, one of the stuff that we've experienced over the last 2 or 3 years. So that is strong. But you have to, again, look under the surface. None of that stuff can continue indefinitely. So we know that strong is strong right now, but there is weakness starting to build up under the surface. So when we look at this, we're saying, look, US economy very strong today. Unfortunately, that strength is almost going to be the undoing for the US because the Fed just has to keep hiking. That recession is going to come. Now, from our perspective, our forecast for the US recession, we have moved it out. We originally had it at Q3. We're moving out to Q4. But we've also added another hike into our forecast for the Fed, so a peak of 5.5%. So unfortunately, it's a very confusing picture. But if you're looking towards the end of the year, the story is still the same. You've got interest rates at very, very restrictive territory, and you've got a US economy which is really starting to struggle because of the lag for monetary policy. Mike
Gapin of Bank of America Publishing just seconds ago, building on some of this. The team writes over there, a big slowdown in consumer demand might be needed for inflation to return to 2%. This could require several more Fed hikes. Jack, when you think about how to invest around this scenario in the equity market, what's the best approach?
Well, I think that everything you and Seema were just talking about speaks to a Fed which continues to be data-led and late. So I think from the equity market's perspective, we began basically in January with a market that delivered a return consistent with, say, JP Morgan's long-term capital market assumptions. So we had a pretty good year in January. I think that highlights the fact that markets are going to shift their focus more towards quality rather than just chasing after what had worked in shorter periods of time. And I think but admittedly, to be really bullish on equities today, you have to have either one of two contradictory statements that you can hold together. One, either earnings massively positively surprised to the upside, seems inconsistent with the recession call that is, I think, still consensus, even if it keeps being pushed back. Or two, interest rates have to collapse, I think, from here, which seems unlikely absent a recession. So, when I put all that together, I still think equities are a better return on capital story on the intermediate to long term, given some of the embedded inflation pressures that still remain. But I do think you have to focus much more A, on quality, and B, on dividends. Get us some money, which borrows a bit from the excitement investors came into this year with fixed income being back. So show me the money effectively.
Where are you finding those dividend opportunities, Jack? Is it healthcare, energy still? Are they the two sectors for you?
Well, I think those are two places that offer us a unique combination of, in the case of healthcare, value. They offer us some longer term growth coming from demographics when we think about an aging population and some of the labor pressures from people opting out of working because of healthcare reasons. And they offer you income. When I look at energy, you wind up getting income. Maybe that we can say the valuation story is a little less compelling in the energy sector. That's a bit more of a macro trade. So effectively, we kind of need China to continuing to return with reopening. But when I look at U.S. energy companies, they're letting their investors decide their reinvestment. I think that's really powerful from a long-term perspective as they combine share buyback and dividends.
Equity futures right now on the S&P 500 up by 0.8%. of 1%. We've got a bounce in the equity market this morning. Yields are a little bit lower by 3 basis points, 478. If you go back to the start of February, the closing high in the S&P 500 coinciding with the intraday low of the year on the US 2-year. The 2-year yield back then on February 2nd, 4.03%, and this morning was in and around 483. That's an 80 basis point move in a little under a month. A massive move. And Mike McKee, the conclusion appears to be this Fed, Mike, has more work to do.
Well, it appears that way, John. Now, what we're trading on in terms of the bond market right now is what happened a month ago in January, because February has been a month where we're getting surprising numbers that happened in January. So it'll be tomorrow when we start getting some up-to-date numbers. We did get durable goods today, better news than the headline. Headline pushed down by Boeing, but most of the products underneath that rose, including non-defense capital goods, ex-aircraft, which is what goes into GDP, up 0.8%. Shipments were up 1.1%. But this week, tomorrow, we get some consumer confidence numbers for February and the Chicago PMI. That kicks off a busy week, but not the week that everybody was waiting for, because we do get the ISM numbers that'll give us some idea of manufacturing and services, but we do not get jobs this week. I had just gotten, when you were introducing me, an email from one of our clients who is watching, who wants to know why not. They do the jobs report, they release the jobs report the third Friday after the week that includes the 12th, which is the survey week. And because February is short, it pushes it to March 10th. We have gotten, in the latest month, though, a huge number of surprises. You saw that there, the City Surprise Index moving up very rapidly, and that's what's influenced all the bond buying. Now, take a look. Here's what we're going to be watching, and this is when it really gets interesting, is next week, even before jobs, we have Humphrey Hawkins, Jay Powell testifying before Congress. So that is going to be your market. You're probably... Well, I don't know. Do you think jobs, John, will be?
I think he probably wants to reschedule that for March 15th, to be honest with you.
I'm sure he would. CPI March 14th, and then the Fed meeting is March 22nd, and that'll be when we get the new SEP, the new dot plot, and we'll see if the Fed's view of what it needs to do matches what the market thinks.
Can I pick up on the question you were trying to ask me, because I think it is an important one? Yeah. What do you think is the most important one? Is it to see if payrolls confirm what we saw in January? Is it CPI again after PCE last week? What is it?
Well, I think the risk is that if we see the payrolls report ultra strong, it'll override maybe some of what Jay Powell says, because, as you noted, Powell has to speak before it comes out. But it'll be interesting to see if he ratifies in any way what the markets are thinking about what the Fed has to do, so people can set up for that March 22nd meeting, and then we'll see whether the CPI and jobs reports also underpin that.
Mike McKee, thank you, sir. A quiet week relative to what we're going to be expecting in the next couple of weeks. Looking for payrolls March 10th, then CPI a week or so after that. Seema, first to you, just how high is that bar to go away from 25 and return to 50s again at this Fed?
I think it's fairly high. I mean, realistically, looking at the data, I think they should be going at 50. I think they should have still gone at 50 even last month. But you know, they continue to get things wrong. That's unfortunate. We talk about markets being rocked around. Well, one of the reasons that they've been rocked around is because we're following the Fed, right? We're listening to the Fed. We heard Powell talk about the fact that financial conditions haven't tightened. And I think that really helped this narrative for the market that things are going to be okay. But as we know from last year, the Fed kept getting the inflation picture wrong. And for us, it's really important now to have a clear narrative. Now, I don't think the Fed is going to move from 25 to 50. I think they're going to go at 25, and they're going to go for a couple more 25s before they come to end.
A series of 25 basis point hikes is the call from Citi as well. They're looking for a peak rate of 525 to 550, at least, a minimum perhaps. They go on to say the bar to re-accelerate to 50 basis points is high, but it makes sense for markets to price some probability of larger hikes, and we've been doing just that. I want to get to one more research notice from Mislav Matejka at JP Morgan. He published earlier this morning. He said, we believe Q1 will mark the high point for the index levels this year, as the fundamental uplift does not come in Q2, Q3, post the relief in activity that is seen in Q1. This suggests that one should be turning more defensive as we move towards quarter end. Now, Seema, let's assume you agree with that based on what you've said so far. Could you tell me what you think defensive is in 2023 compared to what defensive used to be?
So defensive within equities is, I think, it's going to be the mid-cap space, and it's also moving away from the US. That is unusual because typically in any kind of economic downturn, you usually run for the US. This is the time to look international, Europe, emerging markets. The other part of this is if you can get out of equities, start looking at fixed income and alternatives. because that's where you're going to add a little bit of protection. It's not ideal, certainly, at this point in time. We can see there's a little bit further pain to come, but we do think that that's a safer place to be positioned than what you're going to get from equities.
Seema, we're going to talk about that theme in just a moment. We'll talk China. Seema Shah is going to stick with us. Jack Caffrey, JP Morgan. Hey, Jack, wonderful. As always, thank you, sir, for joining us. Your equity market up by 0.8%. I want to get you some movers. We can do that with Abby. Morning, Abby.
Good morning, John. And one reason that we do have futures sharply higher, the shares of Union Pacific absolutely soaring, heading to the best day since March of 2020. This, of course, on an upgrade from B of A to a buy with a new price target of $241, which is 10% better than the old one. On the news that they are looking for a new CEO, this following pressure from a hedge fund, Soroban Capital Partners. They're pushing for Jim Vania to replace Union Pacific's current CEO, Lance Fritz. Mr. Vania has experience posting improvement at Union P in the past. This, of course, as the COO. Again, investors liking this news, that stock absolutely flying. As for it being an M&A Monday, well, we do have some deal news. Oncology biotech Seagen absolutely soaring as well, up 13.4% in early stage talks with Pfizer for a takeout. They turned down a $40 billion deal last year with Merck, so analysts are very encouraged here, thinking that they could get a big premium. Range Resources, on the other hand, it is down sharply, down 8%. They are not a target for Pioneer Natural Resources, as had been rumored last week. And then finally, the biggest loser on laggard on the morning here in the pre-market, Tegna. This media marketer, well, the deal with Standard General may be dead on FCC opposition. That stock down more than 20%.
Abby, thank you. We'll pick up on a few of those stories around the opening bell. Going into the opening bell, 14 minutes away. Equity futures still higher. At the front end of the yield curve in the Treasury market, the 2-year was 4.85 a little bit earlier this morning. We've backed away from that. We're now down 2 basis points on the session to 4.79. Coming up, the White House delivering a warning to China.
Beijing will have to make its own decisions about how it proceeds, whether it provides military assistance. But if it goes down that road, it will come at real cost to China.
That conversation up next.
When China talks rhetorically about the war in Ukraine, they tie themselves into knots because they know that going all in with Russia in this war in Ukraine would alienate a substantial number of countries that they are working hard to maintain good relations with. This war presents real complications for Beijing. And Beijing will have to make its own decisions about how it proceeds, whether it provides military assistance. But if it goes down that road, it will come at real cost to China.
The White House warning China against supporting Russia's war effort as China prepares for a state visit by a Russian ally. The country in the spotlight over the weekend as the Wall Street Journal reports that a lab leak was the most likely cause of the COVID-19 pandemic.
I can't confirm or deny. If we gain any further insider information, we will share it with Congress and we will share it with the American people.
On the latest down in Washington, AMH down in D.C. Morning, Anne-Marie.
Good morning, John. Some awkward diplomacy with China. On one hand, of course, you had Jake Sullivan out on the Sunday shows, the president's national security advisor, talking about and warning China that they are watching them on whether or not they will take this step potentially. Cross with the U.S. has really highlighted a red line in providing lethal aid to Moscow. The president said at the moment he doesn't think that's possible, but he said there would be consequences. Of course, the big question is what those consequences would be. And then we find out from this Wall Street Journal report that the Energy Department has changed their assessment about the origins of COVID-19, and they're saying this is coming from a lab. Now, what you heard Mr. Sullivan talk about is the fact that there is really no concise agreement amongst the entire intelligence community. But of course, this would make diplomatic arrangements with China even more complicated than they already are. And China already fighting back, saying that this is scientific and it should not be politicized. And right now they're blaming the United States for politicizing it.
MH on the latest. Anne-Marie, thank you down in Washington. Back with us for final thoughts. Seema Shah. Seema, I wanted to come to you on this. We talked about this over the last couple of months. China's gone from uninvestable in the last year to unavoidable and now somewhere in between. I want to understand from your perspective, do US-China relations and the tensions currently prevent you from taking direct exposure to the country?
It doesn't, but we do have a bit of caution here. So when we're looking at the China position, we're looking at it from about a 6-month perspective for a number of reasons. So one of them is certainly the geopolitical tensions, which do seem to be resurging, and we certainly expect that as China becomes a strong economic player again, then it's going to be in the interest for the US to try and push them back again. But the other part of this is that, when we look at the China reopening, there's a lot of investor sentiment exuberance. We certainly think that's going to carry China a little bit further. But we also have to start thinking about policymakers and what they're going to do with stimulus. So we're not entirely convinced that stimulus is going to be extremely strong, that could continue to carry China's growth very, very far. So this is a 6-month perspective from our side, and then we're going to revisit and see if it's something that we want to stick in or not.
Isima, how closely are Chinese equities and so-called China proxies correlating with US equities?
Well, actually, so that's a good question. So it is one of the things that we've been watching the correlations, that they have got a little bit closer in the last couple of weeks. But one of the things which I think makes sense is that as expectations for Fed tightening have gone up, and you've seen the further strengthening in the US dollar, a lot of the China proxies, of course, emerging markets, are starting to struggle, which is what you would anticipate. Now, for this year, that is going to be an important narrative to watch. We have to see what happens with the US dollar. But either way, whatever we think about the Fed, if we believe that we're closer to the end of the tightening cycle than the beginning, then it should mean that we're near the ultimate peak for the US dollar, and then that should continue to help emerging markets and China proxies going forward. But as is anything for this year, a lot of the economic variables need to be watched very, very closely.
I think for the year so far, the answer is ask me again in a month or a week or 24 hours, Seema, based on what we've seen. Seema, thank you. Seema Shah there on the latest. Equities right now on the S&P up 0.8%. Coming up the morning calls and later. Markets starting to price out the Goldilocks scenario. We'll get the latest with Sam Linton-Brown of BNP Paribas. Five minutes away from the opening bell, a lift here on the S&P by 0.9%, looking to recover on the Nasdaq by 1.1% on the Nasdaq. Futures going into the opening bell. Let's get you some morning calls. 3. Here's one. Bernstein downgrading Williams to market perform, expecting lower gas prices given the warmer than anticipated winter weather. That stock's down 0.5. Next up, JP Morgan initiating coverage on Zillow with an overweight rating, forecasting a recovery in the real estate market. That stock's flying, up 4% in the pre-market. And finally, Telsey Advisory downgrading Best Buy to market perform, seeing further downside given the challenging macro environment. That stock is down by 1% to 82.85. Coming up, BNP's Sam Linton-Brown was buying the beaten down European banks last summer, and they've been absolutely ripping ever since. That conversation still ahead. .24 seconds away from the opening bell this morning. Good morning to you. Equity futures elevated by 0.9% on the S&P 500. On the Nasdaq, positive 2 by 1.1%. Last week, worst week of the year on the S&P 500 for 2023, and a 3-week losing streak that we are going to see if we can snap. There's your opening bell. Switch at the board and get to the bond market. Yields were higher this morning and then lower by 3 basis points on a 10-year, 390. We had a little look again at 4%, couldn't make it. On a 2-year, came basically close to 485 and some, 478. We've backed away since then. We're down about 3 basis points on the session. In the FX market, the euro showing some strength after a week of weakness every single day last week. Monday, Tuesday, Wednesday, Thursday, Friday, euro weaker. Now 105.83, a bounce of about 1/3 of 1%. And crude, down 1/2 of 1% this morning, just short of 76 at 75.94 on WTI. About 30 seconds into this, equities advanced by 0.8% on the S&P. On the Nasdaq, up by a little more than 1 full percentage point. 2 stocks to watch at the open. One's Pfizer, the other CGen. The Wall Street Journal reporting the 2 companies are in early stage talks for a potential acquisition. Analysts expecting a deal for CGen could cost Pfizer more than $40 billion. Abby has more. Hey, Abby.
Hey, John. Well, we saw a similar story last year, only it was Merck, and it was a $40 billion price tag, but apparently CGen turned it down. So analysts encourage that maybe something something will happen here. But it is important to stress what you were talking about. This is Wall Street Journal reporting, and this is in early phase talks, if at all. And what is happening here, analysts saying that after basically a year of waiting for Pfizer to do something significant, they've done a lot of little bolt-on deals, that this potential acquisition shows that Pfizer is serious about growing their revenue beyond COVID. They're also saying that they appreciate the long-duration IP and exclusivity around some of their antibody drug conjugates. And JP Morgan's very positive, Berenberg's positive, so it seems as though there is support for this. Now, relative to that revenue concentration, about more than 50% of their revenue in the fourth quarter had to do with COVID. So with COVID on the decline, hopefully, they're really apparently looking to boost up the diversity of their revenue and really particularly around oncology. As for Seagen's side, just a few shareholders here calling the shots. The Baker brothers have 25%, then Capital Group at nearly 14%, Vanguard, BlackRock, Wellington, PrimeCap. Again, last year, apparently with Merck, they were not interested in a $40 billion deal. That is the number that's being thrown around here. And again, if it's happening, early stage talks here, John.
Abby, thank you. Seagen up by a little more than 11%. Seconds ago, just some breaking news out of the UK. The UK and the EU reaching a deal to end the so-called Brexit dispute over Northern Ireland. There will be a news conference a little bit later, 3:30 UK time. So that's about an hour from now between Rishi Sunak, the British Prime Minister, and the EU President, Ursula von der Leyen. Look out for that news conference a little bit later on this morning. Guy Johnson, Alex Steele will pick up that story in about 28 minutes' time. That headline dropping just moments ago. The UK and the EU reaching a deal to end the Brexit dispute over Northern Ireland. More on that a little bit later. One stock to watch around the opening bell, Union Pacific. The company saying that it's looking for a new CEO following pressure from one of its largest shareholders, writing, quote, "The board is focusing the process on highly qualified candidates to identify a CEO capable of leading the company for a long-term tenure. The board expects to name a successor who will assume the position in 2023. Isabel Lee has more. Hey, Isabel.
Hi, John. That's exactly right. And if you ask Ferro Capital Partners, a hedge fund, there's only one person for them, Jim Vena. Vena used to be the company's chief operating officer from 2019 to 2020, and he's known for his major cost-cutting measures and his efficiency style, which is why shares gained when he was the COO. And Soroban, who has a major stake in the firm, said, unlike typical shareholder engagements which come with major demands, it only has one ask, and that's to install new leadership. It even goes so far as to say that UNP's stock price will double in 2 years with Vena as the boss. It also said that no one is internally as qualified as him. And of course, Wall Street was quick to react. We have Bank of America Global Research welcoming the news. It upgraded the firm's stock to buy from neutral. It set a price target of $241. That's a roughly 24% increase from the close. JP Morgan also saying that the takeover will be a positive for the stock. It keeps its neutral rating. So Vena helped overall Union Pacific's operations a week ago, and you can see the margins fell after his exit. As background, Union Pacific has been the second weakest performing rail stock in 2022. Its shares fell around 20% in the past 12 months. This is why some investors are quite unhappy with his performance. So Union Pacific said it will name a successor this year, and we'll see how that plays out, John.
Some relief this morning. Isabel, thanks for that. The stock is up by about 9%. If we closed here, one of the best days we've had for that name since 2020. From rails to retail, Telsey Advisory downgrading Best Buy ahead of Thursday's results. The analyst said this: we believe Best Buy's business is likely to experience a further decline related to the challenging macro trends weighing on discretionary consumer demand, given high inflation and rising interest rates, resulting in our lower 23 forecast for both sales and profits. Katie Greifeld has more. Hey, Katie.
Hey, John. Well, Best Buy shares are actually a little bit higher as trading officially kicks off. The stock had been lower pre-market. But in addition to the downgrade, you also have analyst Joseph Feldman. He cut fiscal year estimates for Best Buy, and it lands before Best Buy reports earnings on Thursday after what had been a pretty robust upswing. Shares had gained more than 30% between the end of November and early February. But as you can see from that chart, it's been in a bit of a downdraft the past few weeks. And it's not just Best Buy, John. You have other appliance sellers and consumer giants. They've also dropped over the past 2 weeks or so. And actually, in downgrading Best Buy, Telsey's Feldman cited disappointing outlooks from Home Depot, from Walmart, as signs basically that those difficult macro trends, they're going to continue to weigh on discretionary consumer demand. Now, longer term, Feldman does see Best Buy as one of retail's better operators, but the era of easy post-pandemic comps, is over. You're looking at same-store sales there, and it's another double-digit drop that's expected. That would be the 5th straight quarter of declines. So stay tuned for Thursday's report.
Katie, thank you. As Katie pointed out about 6 minutes in, we were lower. We're now positive on that name. Best Buy up by about 1%. The broader market on the S&P 500 positive by 0.75%. The Nasdaq up a little more than 1 percentage point. Sam Linton-Brown of BNP Paribas keeping a close eye on this week's data, writing the following. The market has started to price out the Goldilocks divine disinflation scenarios, which were underpinning the everything rally, in favour of economic resilience but stickier inflation. Fundamentally, our view remains that activity data will eventually slow by more than the market is pricing in. Sam Linton-Brown, I'm pleased to say, joined us now. Sam, wonderful to catch up with you, sir, as always. You didn't really buy into the divine disinflation scenario. You're not buying into the resilience story either. Why not, Sam?
Good morning, John. Our view is that either growth needs to slow by more than the market's currently pricing in, or central banks will have work to do. So in January, the market was pricing in a scenario where inflation got to levels consistent with central banks' mandates, but without any material slowdown in growth and without policy having to get that restrictive or stay there for that long. We've had a bit of a repricing in the market in February, where there's more concern now that central banks will have more work to do if growth doesn't slow. We've priced central bank expectations higher, we've priced inflation expectations higher, and we've priced out the timing of rate cuts following when terminal rates will be reached. The view we have at BNP Paribas is that there's still some further room to run on that repricing. So either equities are at risk to come lower or rates are at risk to still head higher.
If you had a bias right now, Sam, which one would it be?
I think in the near term, the bias is that both could actually play out on the basis that the market's in this process of pricing a more hawkish policy outlook for the Federal Reserve. The data we have this week is going to be important: consumer confidence, ISM manufacturing, ISM services, but more crucially will be the payrolls data that we get just beyond a couple of weeks from now. I think the key point here will be on earnings. The view we've got, sorry to cut you off there, John, is that you could have an upside surprise on earnings because average hourly earnings doesn't take into account compositional changes in the labour market. And what we've seen is that some of the higher wage cohort have been coming out of the labour market, while some of the lower paid workers have been coming in. And that trend might be due a bit of a reversal, which will push wages from payrolls higher in line with things like the employment cost index. That could trigger a further repricing in Fed expectations, which would challenge the risk backdrop.
Sam, based on your expectations, when you compare Europe to the United States right now, where do you think is closer to pricing in the terminal rate? At the ECB or the Fed?
I think in the US, in the near term, that's where there's a greater risk that the market needs to price tighter central bank policy. In Europe, we had a pretty significant repricing already as the market has priced out a recession on the basis of the energy crisis proving considerably less acute than had been expected. In the US, we're getting this ongoing surprise, however, where data simply is not slowing by as much as the market expected, either because policy lags are longer than people had anticipated, or because central banks still have more work to do. That means we're in a scenario where there's really a lot of uncertainty for the market to be processing. And I think where the market's currently priced for the Fed is fairer than it was before, but from a risk-reward perspective, from a distribution of possible outcomes, we're probably nearer to where the market's likely to price the floor than where it's likely to price the ceiling. So we remain a bearish bias in the front end of the US curve. In Europe, it's a little bit more balanced. We'd be neutral on both duration and the front end.
Where does that leave the bank's call then, Sam? And let's pick up on that. I remember the call from last year. It was last summer. I think it was around the middle of June. You said buy European banks. And I sat here just thinking, is this guy absolutely crazy? Is he nuts? A month later, the S&P, or rather the Euro Stoxx 50 Banks Index bottomed. And I think we're up something like 50%, 60% from that low. I think this year alone, year to date, we're up 20%. Sam, what did you see that ultimately materialised? And whether, I want to know, whether you're still long this sector.
Well, that's obviously a very generous characterization, but nonetheless one that's appreciated. Our view from here is that banks in Europe are still set to outperform. We think net interest margins have further scope to improve. In turn, the profit outlook is structurally better against still depressed valuations. So European banks are still a sector that we think will outperform. And more generally speaking, we think the European equity market is at less risk to sell off. Again, consistent with what we think the central bank might get priced to do from here than the US market. In the US, if we look at some of the more interest rate sensitive sectors, i.e. NASDAQ, trading at a 23 times, 1 year forward PE. For us, that looks too rich from a valuation backdrop, given the headwinds that will be felt from higher rates.
The enthusiasm you have for European banks, though, do you have the same enthusiasm for US banks? You talk more broadly about US equities and the NASDAQ there, but what about the banking sector stateside, Sam?
We'd be comparatively more cautious there compared to Europe. The valuation argument is less compelling than it is in Europe. I think as well as we talk about the relative equity call, that's going to tie in very closely with the relative currency call between the Eurozone and the US. Our view on euro dollar is that we're structurally bullish in the medium term. We talked about if the ECB have more work to do. I'd say almost independent of that, the key point in European fixed income is there didn't used to be any yield, now there is. From an equity standpoint, we know that Europe is an under-owned market. It's a market that's been beat up for many years. We think secularly that trend is in the process of reversing. And from a currency valuation point, it's still very cheap. So we think in the medium term, euro dollar is set to trend higher, even if we might be in this range-bound, choppy consolidation zone on the basis that Fed expectations might get repriced a little higher.
Sam, can I just put a number on it, if we can? I remember the day before payrolls, it was the day of the ECB. I think we saw 110.33 on euro dollar. We're back down to 105. What kind of levels are you thinking about?
I think we'll sustainably break 110 this year. Our target for the end of this year is finishing in the 110 to 115 range on the higher side. So we have a 114 number, and I think that's very much achievable. Interestingly, the repricing higher we've had in Fed expectations on the back of better US data, that's good for the dollar now. Higher rates are going to squeeze out what was a very strong consensus dollar short position, which had been built in the market very quickly, in our view too quickly, in 2023. But once that process has played out and US rates are somewhat more stable, the backdrop is one in which, relative to where we were 2 months ago, recession risks have diminished. And that type of backdrop where growth expectations are revised up is one which should be ultimately bad for the dollar, even if in the near term, while Fed expectations are just higher, it can squeeze out some dollar shorts.
Hey, Sam, this was great, and great call last year as well. Keep talking about it. Sam Linton-Brand there of BNP Paribas on its equity market and on that banks call from last year that's really materialised in a major way. You brought a market right now, 14 minutes into the session, positive by 0.8% on the S&P and the NASDAQ, up a little more than 1 full percentage point. Coming up, more job cuts at Twitter.
There was a decent amount of overhiring across tech and in software and parts of semis. And we've seen those companies get out ahead of the market in terms of announcing layoffs. So that's been really productive.
That conversation up next.
This is Bloomberg's The Open. I'm Lisa Mateo, live in the principal room. Coming up, Boris Vujicic, Croatian National Bank governor. That conversation at 11:30 a.m. Eastern, 4:30 p.m. in London. This is Bloomberg. There was a decent amount of overhiring across tech and in software and parts of semis. And we've seen those companies get out ahead of the market in terms of announcing layoffs. So that's been really productive. And so I expect these companies are going to weather this economic and policy storm pretty well.
A fresh wave of cuts over at Twitter. The layoffs hitting employees across the company, including engineering and product teams. Sources telling Bloomberg some employees learned the news via an email, others finding out when they couldn't log into the internal system. Kaylee Lyons joins us with more. Hey, Kaylee.
Hey, John, it's not exactly clear how many
Employees were laid off in this round of cuts from the company. Sources told Bloomberg that they believe it was in the dozens. The information it reported, it was about 50 people. And while that may seem like a relatively small number, remember, this follows 3,700 job cuts back in November. Excuse the number there on that full screen. Remember, Elon Musk took over this company after overpaying $44 billion for it, immediately cut about half of the workforce closely after closing that deal because he needed to cut costs. And once again, we are seeing that happening over the last several days, including even in the higher ranks of those left at the company. Platformer saying among those cut this weekend was Esther Crawford, who was one of the executives who had been in charge of the subscription service Twitter Blue. Now, obviously, a lot of this is Twitter specific, but John, this is part of a broader trend that we are seeing in technology. Companies having to right-size their businesses, reduce their workforce now that they aren't growing like they were in the pandemic when they hired so many people, which is why we have seen over 100,000 layoffs in the tech sector over the last several months. And it's showing up in the economic data as well. You're seeing in the information technology sector jobs going down in both the last reports, December and January, even as overall employment picked up. We'll have to wait and see what the latest data tells us come next jobs day, next Friday, John. But obviously, there is a lot of pain being felt in the tech sector right now, and especially for their employee force.
March 10th, the next stop, 2 Fridays away. Katie, thank you for the latest. As always, Katie Lyons there on Twitter. An eventful weekend for Elon Musk, a busy week coming up for him as well with a different company. Tesla's annual Investor Day coming up on Wednesday. The EV maker presenting a third version of Elon Musk's master plan. Musk writing in a tweet, the plan includes, quote, the path to a fully sustainable energy future for Earth. David Welch has more. David, walk me through what's on the agenda this week at this Investor Day.
Yeah, they haven't said much, but I think one of the big items has to be the whole supply chain of batteries. Everyone's racing right now to secure contracts to get lithium, to get cobalt, nickel, everything you're going to need. Tesla has talked about lithium iron phosphate batteries too, but they're also apparently in the mix to take a stake in Sigma Lithium. So like General Motors has taken stakes in some of the mining companies and mining projects that they need to make all of these electric vehicles over the next decade, I think Elon will talk about how they're going to secure all of the different minerals and metals that Tesla is going to need to hit the huge volume targets that he has going forward. I think another thing will be, does the Model 2, the small, cheap Tesla, is there anything real there? He wanted to do this years ago. Last year he said that they had sort of shelved it, but there's a lot of expectation that maybe he'll talk about that, bring it back to life. They need a cheaper electric vehicle to reach the masses and to hit some of the long-term volume targets that Tesla has. And then also maybe we'll get some more specifics on production timelines for the Cybertruck that we're supposed to see at the end of this year, but there's, this is Tesla. They like to miss, or I don't think they like to miss their production targets, but they often do. So we'll see if the Cybertruck's going to come out on time and maybe get some real production numbers on that as well.
In the past, it just didn't matter if they missed things because, David, the stock performed so well. If you talked to me about this 2 months ago, people would have said the CEO's under pressure. People are asking whether he's distracted. The stock's on its knees. Since then, year to date, up 66%. Is the CEO no longer under pressure and distracted?
Look, the stock is still way below where it was last November. So the company has really, it's come back in recent months, but it's not where investors want the price to be. I don't think Elon's under pressure necessarily, but I still think he's being closely watched. The company is being closely watched. A lot of issues here fundamentally that Tesla has to deal with. They have a lot more competition now. The conventional, or what they call legacy automakers, Hyundai, Kia, General Motors, BMW, Mercedes, are all coming out with a bunch of electric vehicles right at the time when Tesla has a lot of capacity coming online. Tesla's models have all been on the market anywhere from 3 or 4 years to 12 years for the Model S. Some of those are a little stale. They need some new product. They're not hitting their growth targets. So I think they're being closely watched. I don't think there's necessarily an argument that Elon ought to be removed, but investors are going to want to see something that says they're going to regain momentum at this company.
Stock's up right now by 4%, 22 minutes in. David, wonderful as always. David Welch there on the latest, looking ahead to Tesla's Investor Day. Got a bit of time for a sector price check. Let's get some price action at the sector level with Abby. Hey, Abby.
Hey, John. Well, we are looking at the S&P 500 gaining by about 0.8% right now on anemic volume, 22% below the recent average, but holding that 200-day moving average. And it is on strength from a variety of sectors. We have discretionary industrials, real estate, and tech all up more than 1%. The one lagging sector is energy, down about 0.3%. And over the weekend, of course, Warren Buffett released his annual shareholder letter. In terms of the sectors that represent his biggest holding, we have tech and financials up this year, but energy and consumer staples, not so much.
Abby, thank you. Your trading diary up next. Trying to snap a 3-week losing streak on the S&P 500, attempting to bounce back from the worst week of losses of the year so far in 2023. Equities up by 8 or 0.9% on the S&P 500. On the Nasdaq, up a little more than 1 full percentage point. As the price action, let's get you the trading diary. The events you need to be looking for over the next couple of days into the weekend. We'll get pending home sales at the top of the hour. A host of Fed speak. Jefferson, Goolsbee, Kashkari, Waller, Logan, Bostic, Bauman, all on the agenda this week. Goldman and Chevron holding their annual investor days on Tuesday, plus earnings coming from Target. ISM manufacturing, a number of European PMIs as well through the week, with Tesla too. Another round of claims coming up on Thursday with Macy's and Nordstrom reporting as well. From New York, that does it for me. This is Bloomberg.